Welcome back. You're with us here on Opening Fire. So markets are down about 18 points, not really going anywhere in a hurry. 71.45 is where the Nifty is at this point in time. So PSU banks in the third quarter, and I'm going back to earnings, saw unprecedented spike in impairment. I mean, 30% rise in the third quarter following the RBI audit. PSU bank stocks got sold heavily. And I guess that was one reason which kind of sort of pushed these stocks over the edge, along with the broader market being extremely weak as well. One stock which withstood the trend was Bank of Baroda. Unless you've been completely away from the market, couldn't have missed the fact that Bank of Baroda went up 23% post results late last week. It went up 22% yesterday. It's a pleasure to have the management at Bank of Baroda, Mr. P.S. Jayakumar, who took charge late last year with us here. He's Managing Director and CEO at BOB. So thank you very much. Good morning. Good to have you here.
Good morning. Thank you very much.
So we know the story now, and we know what you've done, and you kind of stood out by saying that we've taken all the pain in the third quarter. Most of the banks, actually almost all of the banks, said that we're going to spread it over the next 2 quarters. So just one quick point. Why did you do that? Just a simple question that we can take off from there.
No, there isn't. The point is, if we had not done it this quarter, we would have taken it next quarter. So net result at the end of the financial year is much the same. On the other hand, if you had not taken the numbers, anybody who was analyzing the stock would, in any case, make adjustment for the immediate loss that is going to come in the next quarter. That's one part of it. The second part of it is also the fact that we are fairly well capitalized as a company. And it's an historical fact. And therefore, there is a wherewithal to make the adjustment and move on, because it's still, at the end of the day, even after this adjustment, our capital adequacy ratio, Tier 1 ratio, and CET1 are all looking good. So it's also the particular circumstance of Bank of Baroda.
You know, sir, I think what also sits very well with the market, at least, with the stock market at least, and analysts, etc., is your statement that we don't need immediate capital infusion from the government. You've said no. And I think that got a lot of people backing you there. But I just have a question. Just explain that for us, because, I mean, the provision coverage ratio and things like that. Is there a risk that you are kind of underestimating capital needs?
Well, as you know, you cannot be exactly correct as to what the forecast of the next year is going to be. So what we have tried to do is to create a range of outcomes that can happen depending upon a number of factors, primary one being the economic outlook, correct? So here is how the equation is on the balance. We have certain amount of non-core assets which we can liquidate. These are not distressed sale. The time has come for us to exit from the stock. So that's one element of the process. The second is, at this point of time, we are focused on efficiency. We do hold assets which are, syndicated loans and a bunch of things where the companies on whom we have invested probably do not know we even have invested in these assets. They are not core to us. They're not important for us. So we are kind of exiting them out in a phased manner, thereby providing room for growth of the core customer asset, the long-term relationship that we enjoy. That is the second element of the game. The third part is that we could potentially have deterioration next year. It's always possible. We assume the impact would be less because we're expecting some recovery coming in from the current NPA provided accounts. But let's say that did not actually play out the way we think it should play out. We still have enough revenue coming in from the current next financial year, which should adequately provide for the losses that could happen in a stress scenario. The last thing is that the AQR in some way, if you see, is not customers who are delinquent on our books. That probably might happen in a future point of time, so the next 12 months. We've accounted for all of them this year itself. So some of the embedded risk that exists in the portfolio to some extent has been addressed off. So my point here is not that we may not have slippages. I see that being low, but it could well be higher. All said and done, there is enough capital, enough core earnings, and the availability of selling non-core assets, plus a bunch of efficiency that could release capital to support our core customer franchise, all of which being in place. When you take all of these things together, it doesn't seem to me under the calculations that we should need any additional equity capital to support the kind of growth we need to keep forward.
So problem assets are about 15% of your total loans now, right? Now, any relief from that side will happen if the economy does a little better, incrementally does a little better. And as of now, it doesn't seem that that is imminent. I mean, a recovery or an improvement is likely. I mean, it's more of the same. So where is, at least from getting some relief from what you've already recognized, what you already know is a problem asset, where is that going to come from? I'm not talking about additional business.
Okay, let me try to answer you this way. Certain amount of assets are let's call it NPA and today because they've not completed the project. There are some, there are a bunch of issues that stops them or prevents them from selling the product to the consumers. Those issues are getting ironed out as we see. We also see some efforts on the part of other promoters to bring in some amount of capital or restructure the balance sheet in such a manner there is a good company and there is a bad company, and then therefore taking some portion of it away from the non-performing status that is there. 3, there is a certain amount of NPA that we have on the retail assets. We have not been particularly focused on collection with regard to these customers. We are now putting all the machineries in place, so it should improve. But here is the mathematics of it, and we should always look at it from that perspective. We have, let us say, mass, just rounding it about 40,000 crores of NPA assets. Even if we were to get 5,000 of them in, which is not contributed by economic upturn, but contributed by certain specific facts as they apply to the company, then we release enough provision to pay for the cost of the balance slipping into the next category. So in some sense, the further provisioning on these assets could be defeased. Now let's say all of that doesn't work out and they need not exactly play out the way we want to play out, and let us say we another 10,000 crores of slippage, which could happen, then we are talking about 2,000 to 3,000 crores of provision overall, keeping everything in mind. So put all of these factors, I took the numbers, I said, okay, what is our number? Okay, let's double that up and say that's going to be the loss. Then I looked back at the next year's numbers, I looked at it and said, okay, let's say that's not going to happen, let's reduce it a little down. Still I come with a positive number overall in the financials. And given the fact that a large part of the customer asset growth are going to be funded through a combination of changes in the category of assets for the reasons I mentioned, and these are good reasons to make those changes, and the fact that we have broadly revenues coming from sale of non-core assets, on the balance, I think we are well positioned. So that really is why we stand up and say, listen, we don't need additional equity capital at this point of time.
So the second point that you mentioned about removing some of these bad assets, putting it into another entity, could you explain that a little bit? It's a bit like a bad bank, good bank?
No, I wasn't saying that. Let me explain to you. We, for example, in our overseas market, participate in a lot of syndicated loan transactions. We do that over here as well. These are cold relationships built only for tactical purposes that you have liquidity. As you start managing the balance sheet, we need to ask this question, do we need them? And then the answer to that is, no, we don't need them. We are just holding them because it just happens to provide us a slightly better return than holding, say, an SLR security, the government securities. We exit from these in an orderly manner. And then that capital that is released is available to support the growth of the business. That's one. And there's a lot of mathematics around it. For example, we have been for most part lending to BBB customers. They have a standard risk weightage of 1. We are upgrading and focusing on customers of the next level. The risk weight capital required with respect to that customers is lesser. So even while we grow the balance sheet, the incremental amount of capital that you require is not like to like. So as you rebalance a balance sheet and move away from assets that you don't need because they don't form part of your core business, and you move into a new class of assets which are of a better risk rating, because that's required to rebalance the portfolio, and then you do the calculations around it, and then you say this is the amount of capital that you need, that is reasonably well funded in the scheme of things. So those are all the things. Focus on inefficiencies, move away from things that are non-core, exit customer relationships or exit cold nose relationship merely because they exist at this point of time for getting a little bit of additional revenue, and then move all of that and focus on core customers and do it well. We should do better. That's really what it is. So That's what we are focused on. As far as the specific numbers are concerned, I've shared it with the analyst meet exactly which line what comes from. So these are numbers based on calculation, not assertions based on future expectations of outcome. Again, I'm saying there's a range of probability, and we are taking the worst case from an equity holder's perspective and saying even in that case, we would not need equity, although we may disappoint you from a return on equity or a shareholder's return perspective.
Right. Fair enough. Sorry, just this the point that you made that AAA, the risk weight is a certain number, and then you go higher where what you need is a lower risk weight. Could you just explain that point?
No, I'm just saying from a Basel perspective, it's not that every asset requires the same amount of capital. Depending on its risk characteristic, it requires more, it requires less. In order to rebalance our portfolio, which is necessary to do, in other words, you have a more diversified set of customer assets that provides you opportunity with growth and also provides you with insulation from risk. We are therefore changing the mix and profile of the customer base. Now, that's not always easy to do. You then need to upgrade a lot of things a lot of customer service, a lot of products. You need to change your process. You need to upgrade the quality train your people better. So all of that is going in parallel. So it is kind of a transformation that is happening here, changing the type of customers we've been dealing with, which largely have been people who have walked into the branch, or consortium shares that we've been provided, to a more active approach of knowing whom you want to work with and reaching out to them with products and solutions, and then making the appropriate technology and other changes that are required to do that. That is a process in which you actually achieve better results. You get the type of customers you need, you serve them better, you get a larger share of the wallet, and you balance out the portfolio. That's what we are working on. So it's not one single silver bullet over here. It's a bunch of things that we need to do. But at all points of time, we need to be cognizant that what we plan may not necessarily be the outcome, or what we desire may not necessarily be the outcome. And therefore, we need to keep the stress state in our mind and then answer this question, in that circumstances, do we need a call on capital? If the answer to that is no, then we are well positioned. So that really is what it is. So I really don't want to say there is going to be no further NPA. Those are all statements what one can't make, because one doesn't predict the outcome, one doesn't control the outcome. What one can say is, listen, there is a range of probability. We have a series of plans to deal with those range of probabilities, and as things stand, we have enough of capital, enough of other assets that we can liquidate, and so on and so forth, as I just explained, and say we still will come out okay. Sure. In fact, we should come out better. That's really what it is.
Sure. So, out of the problem assets, typically, what would you say? What is completely unrecoverable? How much would you have to write off? In that sense, if I were to put it plainly.
Okay. Okay. Let me explain to you in this manner. There are broadly 3 to 4 categories of assets that we have. Okay. Let's deal with the large companies. They usually tend to be binary. Either they pay, they don't pay, or they partly pay. With respect to these accounts, what the best thing probably would be to do is to go account by account and see what is the real value of the firm as it stands today, and what is the debt it has got, and the difference between the real value and the debt must at some point of time be addressed, unless the economy itself changes and the real value of the firm itself goes up. So that's one way of looking at the portfolio and asking the question, are the provisions adequate? We have had a considerable look at that, and it seems to us that we are okay. As far as the retail portfolio is concerned, it tends to behave in a particular statistical manner. And the way you improve the performance is to increase the intensity of collection, and you also bring in some data analytics to know which customers are likely to pay and pay more attention on them, and you need a bunch of curing strategies to address and allow them to recover. So in effect, there is depending on the nature of the customer, type of customer, we have to play it out differently. So that's really that's how we have looked at it. I hope it answers your question.
Right. A number would have been very useful, but no, qualitatively it does answer.
What number do you want? I'm quite happy to share with you numbers. We have them. You tell me what is that you're looking for, and we can try to answer it.
My question was what?
But remember, I again want to tell you. Go ahead.
No, what is What is recoverable and what do you think is bad? I mean, you can't, unrecoverable essentially. What would need to be written off? That's from the existing stock of bad problem assets, problem loans. Yes.
No, you know, wherever we have lending which are principally based on stock and book debts, usually when there is a problem, neither of them exist. And even if they exist, they are of pretty poor value. And on those accounts, you know, we need to recognize that the standard provision of 20%, 30% doesn't really work. We probably are losing 80 to 90%. So those categories of assets, we have kind of looked at them and then made appropriate adjustments to reflect that position. But thankfully, we don't have too many of them, so we are able to right the problem. As far as the larger asset categories are concerned, it is an account-to-account story. There are a number of instances where promoters are bringing in capital or they're giving other alternative assets which are performing and trying to rebalance the debt of the company between the different vehicles such that the total debt remains the same, but our quality of our portfolio is improving. So that's one approach. There are others who are selling some of their assets. There are some where we are swapping the properties they have for our loan, and then we will figure out a way of winding down from those positions. So that said, there are certain assets that are companies where the exposures are large, companies that are big, and especially in some of the metal sectors, where we probably will take a little bit of time to recover. But at the end of the day, these are hard assets that are there, plant and machinery, producing steel, power, whatever it is. And you know, in this country, putting real assets is not that easy a thing to do. So there is the economic value. Maybe somewhere there is no power, no coal link. Somewhere the SEB is not willing to pay a price at which these plants could work. So there are a number of situations like that. But at the end of the day, they're not going to get to zero. They probably are not going to get to 50. They will recover, but we need to be a little bit patient about some of those assets. And that's really what it is. So trading assets, finance the traders, finance those without collateral, likelihood of recovery is low, and then there is a range of outcomes that are possible on the remaining. Some have to take a haircut, some would bring in capital. We put all of these things together and look at it in a kind of exhaustive way. And so these pluses and minuses work, and in our case, we're expecting for most part they will cancel each other out. And therefore, the coverage ratio that we have provided today is reasonably adequate at this point of time. And then, of course, there are regulations that may make us take more coverage even if we feel it's not required. At those points when those events are triggered, we'll have to obviously take them. So I'm trying to give you kind of an answer which probably is a little bit detailed, but I hope it addresses the point.
No, it does, sir. It does. Good luck, and hope to speak with you on a regular basis, sir. Mr. Jayakumar, thank you very much. It's a pleasure, and thanks for the detailed perspective.
Thank you, too.
Thanks indeed.
Thank you very much. Bye-bye.
Thank you. Let's just take a very quick break here. You'll hear from Seth Freeman.